All right, now let's move to the chapter number 5. So till now we have seen interest rate forwards, interest rate futures, and interest rate options. In this chapter, we'll see how do we apply strategies, a combination of all these to hedge our portfolio, speculate, or simply do a effective trading. So here we are going to see three types of players in the market. One is the hedgers, which basically hedge their existing holding. It could be an asset or a liability. Their agenda is to simply protect their investments or their loans. And then we have speculators, basically who are speculating the direction of the market, whether it could go on the upside or the downside. So that's pure speculation. And then there are arbitrageurs. Basically, they are taking the advantage of the mispricing. They are taking the advantage of the mispricing in the market. So they might buy in one market and sell in another market so that their cost is low and there is a guaranteed profit. So these are the three types of investors or traders that we'll be managing and learning about in this chapter. So the first one is hedgers. Obviously, we know that hedgers are basically those type of traders or investors who want to hedge their existing asset or liability. Suppose I have an asset which is going to pay off in next 2 years, but I am worrying about the interest rates. What will be the interest rate at that time? So I might hedge my exposure by entering into any futures or options. Similarly, if I plan to borrow, suppose a company wants to expand and they want to take a loan. They want to take a loan 1 year from now, but they are worried that the interest rate will go up. So they might lock in a rate today by using a futures, forward, or an options. So these players are generally in the market to hedge their exposure, not to actually profit from any trade. What are the three types of exposure? We learned that asset exposure, liability exposure, or a future transaction exposure. Asset means current asset. Current asset that I might have a bond which is maturing in say 2 years from now, and it's a floating bond which is related to the market interest rate, and it's a big payout, say 100 million. Now I am worried that the interest rate might now go up and I might lose on the price, because when the interest rates go up, the prices go down and the bond will lose the value. So I might want to enter into a trade, an option or a future to protect my asset. Similarly, liability, suppose that there's a liability which is maturing in 2 years and it's 100 million maturity, again floating. Here I'm worrying that the interest rates will go down and I might have to pay a larger sum for the bond. So here I might lock in the rate. Future transaction exposure is what we saw in the previous slide. Suppose I want to expand my plant and I want a new machinery and I'm planning to borrow 3 years from now or 2 years from now. At that time, I don't know what will be the rate. So I will lock in the rate today. I will lock in the rate today by entering into a interest rate derivative. So these are the three types of exposures that the interest rate derivatives will be used for. Hedging with interest rate futures, we saw this in the chapter number 3. Long hedge is for assets. Short hedge is for liabilities. You can see expecting to borrow. Borrow means liability. Invest means assets. So to protect current as well as future assets and liabilities, I can enter into interest rate futures. To protect my asset, I can buy the futures which protect against the interest rates following. Similarly, for borrowings, I can sell the future to protect my value because of rising interest rates. So I can long the future to protect my asset, and I can short the future to protect my liabilities. So let's see a practical example of portfolio protection. Consider a mutual fund is holding 100 crores in government securities 100 crores GSEC, and a portfolio duration is 7.5. What it means is basically the payback period for the bond is 7.5 years. In 7.5 years, the bond will pay back its principal amount. The fund manager expects the interest rate to rise by 50 basis points. What happens if the interest rate rises? The duration will be low. because now the payback period reduces, interests are high, which could reduce the portfolio value. Because the interest rate will go up, my prices will go down. That will lead to losses. So how do I protect against this? So we know the formula for portfolio modified duration is value into modified duration into the rate change. So value is 100 crores into the duration. We know that it's 7.5. Expected rate change is 0.5%. So this is the potential loss. This is the potential loss on the portfolio. So this is the amount I need to hedge. Now I need to calculate the number of futures that I need to enter into to protect this 3.75 crores loss. So there's a formula for that in the next slide, but let's understand the steps. Step 1 is to calculate the expected loss. Second is to calculate the number of futures required to protect this number of futures. And third is basically the execution. First is to compute the expected loss. Second is to compute the number of futures required, number of lots required to enter into this transaction. So let's see the formula over here again. For the number of contracts, so in the previous slide, we saw the expected loss. Expected loss is basically duration into portfolio value into expected change of rate. Duration was 7.5, portfolio value was 100 million into expected rate of change is 0.5%, that is 3.75 crores. Now to protect this 3.75 crores, how many number of futures contract I need to buy? So this is the formula. Portfolio value into duration divided by futures price into futures duration into contract multiplier. Contract multiplier is lot size. So when you're dealing in futures and options, there will always be a lot size. In our example, let's consider 100 crores and 7.5 is the duration from the previous slide. And let's assume that the futures is trading at 105 with a duration of 8.5 and 2 lakh rupees face value. If you're dealing in futures and options, there will always be a lot size. In our example, let's consider 100 crores and 7.5 is the duration from the previous slide. And let's assume that the futures is trading at 105 with a duration of 8.5 and 2 lakh rupees face value. Based on this, if we put these values into this formula, we get an approx of 420 contracts. 420 contracts. Now my expectation is the interest rates will rise. My expectation is the interest rate will rise and portfolio will fall because the price will go down. So if my expectation is that my portfolio is going to fall, I would want to sell these futures. I want to sell these futures. And how many futures I need to sell? 420 contracts. How did we arrive at this? Using this formula. So this is called as the hedge ratio. In market, it is also called as delta hedging. Why delta? Because delta means change. Change is, what is the expected change? Change is 0.5%, right? We got this. We got this from the previous slide that the expected rate change is 0.5%. So this is the delta over here. Hence it's known as delta hedging. Note that over here we are taking all fixed values. That's why it's called a static hedge. It's called a static hedge because here we are expecting that this is the futures and it's going to remain as this. But in real scenario, this is never the case. The interest rate might move, the futures value might move, and the overall number of contracts required will move. So in that case, we'll have to enter into a new hedge contract or adjust this hedge contract, right? But for now, for the simplicity perspective, let's understand if you want to protect your asset portfolio from an interest rate rise, you will have to enter into futures. And to enter into futures, how many contracts you require? This is the formula. But this is known as static hedge, as this requires hedging at the start of the contract or at the mid of the contract. But as the future value goes up and down, we will enter into a dynamic hedge that you will see in the slides ahead. So this is a static hedge formula. And as and when the market moves, we have to keep on hedging the portfolio, and that is known as the dynamic hedge. Now let's see the scenario of hedging a future borrowing cost. A future borrowing cost. That means as of now, I have some business plan, and in future, say 1 year down the line, I want to create a factory and the factory requires some borrowing, say 100 crores. How do I protect this liability? So it's a short hedge using interest rate futures to lock in the borrowing cost. A company plans to borrow 50 crores in 3 months. So from now to 3 months, plan to borrow 50 crores by a 5-year bond issue. 5-year bond issuance. Current 5-year yields is 6.5%. The company fears that it will go to 7%. So the expected change is 0.5% positive. That is the rate that they're expecting. So this will increase their borrowing cost because now from 6.5 to 7%, their liability will increase. If my interest rates are going up, my prices will go down. If the prices is expected to go down, I will benefit if I short the future. Because if I'm expecting the prices to go down, I might as well short the futures so that when the prices go down, I make a profit. Understand it again. I'm expecting the interest rate to go up. That means the futures will go down. The bond future should go down because if interest rate goes up, because what is the formula for futures or any price calculation is cash flow divided by 1 plus YTM, which is yield to maturity. Now, if this goes from 6.5 to 7, value will decrease because the denominator has increased. That means futures price will go down. If the futures price is expected to go down, I will short the futures, gain from the downside of the bond. Sell the 5-year GSEC futures contract equivalent to the planned borrowing amount. That means I have to sell 50 crore worth of futures. If rates are rise as feared, the company will pay higher interest on the bonds. So this 6.5 becomes 7. So here is a loss because now I'm paying higher interest. But at the same time, the short future position will offset the increased cost. The short future position will offset the increased cost. The net effective borrowing will be at 6.5 level. So now let's understand it again. I'm borrowing at 6.5 and expecting it to go to 7. That means here I'm going to have a loss. But if I'm expecting it to go to 7, that means the interest rate should fall. So that's why I sell the future. And when the interest rate goes down, the future becomes profitable. So loss over here, profit over here, they get netted off. Not exactly, but approximately they get netted off. And then you're protected against any adverse movement of the interest rate. So now we move to the topic that we discussed in the previous slides, which is dynamic hedge. So as of now, we had seen a static hedge where we saw the number of contracts to be bought or sold depending on the direction of the interest rate. But as I mentioned earlier, that this is a static hedge formula because it does not account for any changes in the yield curve or the market scenario. Now, static hedge remains unchanged until expiry, but dynamic hedge involves periodic adjustment, as I mentioned. When to adjust the hedge? Significant changes in portfolio composition, material shift in interest rate levels. When we say material means, let's say for example in India, which is slightly medium term or comes in a medium term yield curve market, not on the lower side, not in the higher side, but on the medium term. Anything that is below 0.25, anything which is greater than 0.25 will be considered as material because that is the change that will bring a huge profit or huge loss to the bond market. So material shift means major change. Material means major change. Approaching future expiry requires contract rolling. What is rolling? We know that futures can be rolled over. So if I've bought or sold a Jan month future and say there are 5 days left for the futures to expire, I might choose to roll it over to Feb month. So when I want to move from Jan to Feb, obviously the number of contracts will change because now the portfolio value or the yield curve value that I had initially estimated, that will have changed because of the time to expiry and any yield curve movement. So that I'll have to rebalance. Change in correlation between hedged asset and futures. Now what can happen is sometimes you might buy the bond futures, or you might sell the bond futures. So you might sell it or you might buy it. What happens in the market is you expect the rates and the futures to have some kind of correlation, right? This is the rates and this is the futures. But a lot of time the futures will be at discount, or the future will be at highly at premium. That means the correlation has changed. Your original assumption has changed. If your original assumption has changed about the market, will your hedge still hold? Will your hedge still hold? No, because you had assumed something about the market and you had created that number of contracts. But now the market dynamic itself has changed, so you need to do the rebalancing. Dynamic hedge requires active monitoring because you are continuously changing the portfolio value, the portfolio hedge in the number of contracts. Obviously, it will attract additional transaction cost. Why? Because every time you buy or sell, there will be some brokerage, there will be some fees, extra, etc. But it provides superior risk management for large and complex exposure. Now, someone who is having a 1 million or a 2 million kind of an exposure might not get into a dynamic hedge. But say suppose there is a 1 billion kind of an exposure. Now, this is quite material in that sense. It is quite large. So these kind of players will get into rebalancing it continuously and creating a dynamic hedge ratio, also known as dynamic delta hedging. Dynamic delta hedging. Now we move on to the cross hedging techniques. Cross hedging involves futures contract. Let's spot it in futures contract on one instrument to hedge exposure to a different but related instrument. This becomes necessary when direct hedging instruments are unavailable or illiquid. Suppose I want to hedge my loan, but I am not able to find any similar contract in the futures market. I might go and do another type of derivative which will try to hedge this instrument, given that their correlation is high. The correlation of these assets should be high. A corporate bond portfolio manager might use government security futures to hedge corporate bond holdings, as corporate bond futures may have limited liquidity. As I mentioned, correlation. This effectiveness depends on the correlation between the government and corporate bonds. Suppose the correlation is low, will it be effective? No. Because if I am expecting the rates to fall in the government market and then the rates in the corporate bond markets are not falling, that means the correlation is low. But if I want an effective hedge, the correlation has to be high. So it's mentioned over the correlation, relative volatilities and duration differences, credit spread movements between instruments, and liquidity and transaction cost. So we will take this very example which is given over here and I will explain you this in brief with the help of an example. So let's say I have bought, let's say any corporate, like say I took ONGC. ONGC's bond, which is at say 7% example, 10-year maturity. Now this is a asset that I have. Now I want to hedge this, but there is in the futures market, when I go into the futures market, I'm not finding any contract which is similar to this, which is similar to my asset. So what I do, I go to the futures market. This was the corporate bond market. I move to the government security bond market and I find that a 7.2% 10-year maturity national highway bond is available, which is trading in futures. And now I determine that the correlation between them is 86%, for example. Let's say for simplicity perspective. So that is high. That is high. We know that the correlation needs to be high for cross hedge to work. My asset is a corporate bond. It could be ONGC, it could be Reliance or any other company. But I want to expose it. I want to hedge it against a government security because I am not finding a similar security in the corporate bond futures market. So this is known as the cross hedge. A cross hedge is not only limited to bonds of in futures and spot market or futures and spot market for corporate or government securities. Cross hedge will also include currency cross hedges that you must have seen in the currency derivative program. But over here, in short, I'll explain that suppose you have a bond which is in USD and you want to hedge it, but there is no relevant bond which is available. You might enter into another contract which will help you get over the USD exposure. It could be a forex contract, it could be a forward contract or anything, as long as the correlation between them is high. So that is the whole idea of cross hedging. In short, for exam, just remember cross hedging means two different type of assets. Not asset class, asset. Asset class will still be debt market or fixed income, but assets mean it could be a government bond or a corporate bond. Okay, we now move to a topic which you have seen in the last session only, interest rate options. So how do we do the hedging using interest rate options? We can buy the options. We can sell the options. When do we buy the options? When we expect the rates to go high, and we sell the option and we expect the rate to go down, depending on what kind of portfolio exposure you expect. So unlike futures which lock in rates regardless of subsequent movements, options provide insurance like protection. So in the last chapter, interest rate options, we started discussing that option is similar to an insurance where you pay a premium and then you forget it, because that is the maximum loss that you can have on the option. So we'll see this in detail in the coming calculations. But for now, just understand that you can also use options to hedge your exposure, as we saw in chapter number 4. So now we move also. It could be a neutral, it could be bullish. So as I mentioned, you can use options to hedge. Over here it's written using call options. You can buy the call options on interest rate to protect against falling interest rate, rising bond prices. So if your interest rate expectation is to go down, the prices will go up. If you know that the prices of the bonds are going to go up, you will long the bond. So you can long the bond by two ways, either enter into a futures or you can buy the option. Buy means long the options. If the rate falls, the call option gains value, offsetting the higher cost of purchasing. Similar for put options. When interest rate futures rise, when the interest rate rise, the bond prices fall. When the interest rate rise, the bond prices will fall. If you know that something is going to fall, what will you do? You will sell the futures or you will buy a put option. Because in both the scenarios, you will benefit when the prices go down. So this is what is mentioned. When the prices are expected to go up, buy a call option. When the prices are expected to go down, buy a put option. So we'll see an option hedging example. A pension fund holds rupees 200 crore in government securities and wants downside protection against rising rates. Now 200 crores is my portfolio value. Any interest rate change which will go down will still protect the value because prices will go up. But if the rates go up, that means the prices will go down or the portfolio value will go down. So the current position is 200 crores and duration is 8 years. Current yield is 6.5. Let's take a scenario where the rates are increased by 0.75 percentage. Portfolio loses 12 crore. That is the expected change in portfolio value, because that is change in YTM into duration into portfolio value. That is the formula that we have seen. When you put all those things, you get a net 12 crore loss. So now for hedging this 12 crore, I can enter into an optional trade. Now from the previous slide, we know that when the rates are expected to rise, the prices will go down. When the prices go down, you can sell a future or you can buy a put. So in this scenario, the rates are expected to go up. So it fulfills this criteria. So what should I do? I should buy a put. So I buy a put option on GSEC futures, which at the money strike, and pay 0.5% premium. 0.5 of 200 crores is 1 crore. Now, if the rate rises, I'll lose 12 crores, but my put options will gain by 11 crore because the rise in the rate is causing a loss in the bond portfolio. But because the interest rate has risen, the prices have gone down. My put option has created a profit because I was expecting it to go down. So the profit created by put option is 11 crores. So 12 minus 11. So I have reduced my loss from 12 to 1 crore. But to get into the put option, I paid a premium of 1 crore. To buy the put option, I paid a premium of 1 crore. So my total loss is 2 crores because 1 crore from the above transaction and 2 crore 1 crore from the actual premium. So still I have substantially reduced my loss from expected 12 crores to 2 crores. And if the rate falls, if the rate decreases, the portfolio gains, the portfolio will gain because if the interest rate goes down, the prices will go up. So this 200 crore will gain by some amount, which you can calculate, which is change in portfolio value into duration into change in expected YTM. So this formula will give us some, but the options will expire worthless. Even if the option expire worthless, what is the loss on option? What is the loss when you buy an option? Premium. So premium is the maximum loss. We saw that in the last chapter. Anytime you buy an option, whether it is put or call, the maximum loss is premium. So in this case, 1 crore loss on the option and some profit on the bond portfolio. So this is how you can hedge a existing asset or a liability. Collar strategies for cost reduction. We know that collar, we have seen this earlier also. Collar means selling a call option at the same time buying a call option. Why? Because when I buy a call option, I'm paying a premium because I am buying. But if I sell a call option, I am getting the premium because I am selling. So the buyer will pay me the premium. Suppose example, this is 100 and this is 92. My net cost is 8. Had I not sold this call option, I would have had to pay 100. But because I am slightly bullish or slightly bearish, I can enter into collar strategies so that my maximum profit and loss will be capped, but also my initial cost goes down. My initial cost to enter into a transaction goes down. So zero cost dollar. So that the premium received from selling calls equals the premium paid for buying puts. In this case, suppose I find a call option which is 100 rupees as an outflow when I buy the call option. And surprisingly, I'm also getting 100 rupees as an inflow when I'm selling the call option. So 100 goes 0. Hence it is known as a zero cost collar. This provides free downside protection but caps upside gains. So your downside is protected. But your gains are also capped because you are expecting a range bound movement. Buy a put which strike 95. So 95 put buy. So here you're paying the premium plus P, I'll use it. Sell the call which strike 105. 105, sell the call. So here you are getting the premium. Suppose at expiry, both option expire worthless. Below 95 put provides protection, above 105 gains are capped. So what we are doing essentially over here, that the bond price, if it goes below 95, it becomes worthless. If it goes above 105, it becomes worthless because my expected range is this. This is my expected range of movement. Hence, I have tied a collar. That means I have tied a collar against a bond movement. So here my gains are capped and so is my losses. So this is what a collar strategy is all about. Okay, now let's move on to the next part, which is speculative trading strategies. Now, before getting into this section, please be aware that in the exam, you will not be tested on building the strategies or computing complex options and futures, sums and payoff diagrams and anything. Now, the agenda is basically to make you understand how complex option contracts can get into, what are the risks that is involved, and how do you actually compute any payoff or the expected profit and loss. So that's the overall agenda of this chapter. Most probably you will not be tested on any complex question to compute the actual profit and loss other than the very basic ones. But this is more to understand the overall nuances of the options. So this is speculative. So as we say, speculative means that you are expecting the market to move in some direction and you're speculating the movement, whether it could be a short movement or it could be a very volatile movement, or it could be a very silent movement, or you're expecting the market to go nowhere and you want to profit from it. It could be anything, right? So what are the different strategies that are involved over here? So it could be bullish, as I mentioned, it could be a bullish strategy, it could be bearish, or it could be a neutral strategy also. It could be a neutral, it could be bullish, bearish, it could be neutral, that the market is not going anywhere. Now, when it is bullish or bearish, it is a directional trading. When it is neutral, it is a non-directional trading. So you have to remember this: in directional trading, there is an involvement of a lot of risk because you are expecting the option or the market to move in a single direction, and that's why you have to take the risk management into consideration in case the movement happens opposite to your direction. Suppose you are bullish and the market moves on a negative direction, what will you do in that scenario? So that is all that we are going to see in this strategy building.
Yeah, so I see a lot of questions, so I'll just take one by one. So what first one is, what is the importance of correlation in cross hedging? See what happens in cross hedging. You are trying to hedge an instrument, say a corporate bond with a government bond, right? A corporate bond is a risky bond and a government bond is a slightly less risky bond. So if the correlation of both the assets is low, so even if you try to hedge it, your hedge will not be effective. That is why whenever you're trying to hedge any assets, the correlation should be high, so that the correlation needs to be low, or it should be minimal, because if it is high, then it will not hedge, right? It should be low. The correlation has to be low. The second is, how can the duration differences affect a hedge? Now, what happens is, suppose you have a portfolio of bonds. Say you have a portfolio of 10 bonds. Now, each bond is of different duration. One could be a short-term bond, one could be a long-term bond, one could be a medium-term bond. So everyone is having a different tenure of their bonds. And now, suppose you are expecting the interest rates to go up. If the interest rates are going to go up, your portfolio value is going to go down. That means you want to reduce your duration because you want to get out of this scenario as soon as possible. So if you have bonds with different durations, your portfolio duration at a weighted average level, say, is 5, and now you want to get out of this duration and reduce your duration, say, to 2. From 5 you want to get into 2. So what you will do, you will sell the bond futures because you want to reduce from 5 to 2. So you will sell the bond futures equivalently so that your duration reaches up to 2, and any interest rate movement on the upside will not affect your portfolio that much, had it been if you had not hedged your portfolio. The last question is, what happens when the premium received equals the premium paid? See, that is not, in practical scenario, it does not happen. But from a theoretical perspective, what we are explaining over here is, suppose you have a idea that the market is not going to go between, say, 5% yield and, say, 7% yield on the higher side, and on the lower side 5%. Now, since your expectation is between a range of 5 to 7, you would want to enter in a cost effective manner. So what you do, you sell a call option and you buy a call option, because when you sell a call option, you get the premium, and when you're buying the call option, you're paying the premium. So your net off is 0, your outflow is 0, and if the bond remains in that area, or if the bond maintains that area, you will make some minimal profit and your portfolio will also be hedged. So that is the reason people enter into strategies like collar, wherein the net cost outflow is zero.
So the very first one is a leverage speculation example. A trader believes that the 10-year G-Sec yield will fall from 6.8 to 6.3. So here is the yield curve. 6.8 is current. The trader feels that the yield will go to 6.3. This is the expectation. So he buys 100 contracts of 10-year. Why does he buy? Because when the rates will fall, the prices will increase, because yield and price are inversely related. So if the yield is falling, the price will increase. So if you're expecting the price to increase, you will buy. So he buys 100 contracts at 96.5 at a face value of 2 lakhs. So the total exposure becomes 20 crore and the margin requirement is 40 lakhs. So by paying 40 lakhs, he's got an exposure of 20 crores. That is the leverage. By paying 40 lakhs, he's got an exposure of 20 crores. That is the leverage. If the yield actually falls to 6.3, if this happens, the future price rises to 100.5 from 96.5. Profit per contract is 4, because that is 100.5 minus 96.5 into 2 lakh, which is face value. So 8 lakh is the total profit. That is on face value, but you have 100 contracts. So 8 lakhs into 100, that's 8 crore. So 8 crore profit on a 40 lakh margin, that is a 200% return. To enter into a 20 crore exposure, you need not pay 20 crore upfront. You can enter into a futures contract and pay only the margin, which is 2%, which is 40 lakh, and then your expected return is 200%, 8 crores. That is only if you are right. Suppose you are wrong and the yield does not go to 6.8, but it steepens to 7.3. The future price falls below 92.5. Here the future price falls to 92.5. So again 100, 96 minus 96.5 minus 92.5 is again 4 rupees loss. That is 8 lakhs per contract, and into 100 contract is 8 crore. The above example illustrates the power of leverage. By executing only a 40 lakh margin contract, you are exposed to a 8 crore profit or loss. So the idea over here is to understand that you can have a leveraged magnified profit in case the trade moves in your direction. But if it does not, then there is a magnified loss also because of the leverage. So what are the option trading strategies that a speculator will enter into? If he is bullish, he will long, or he will short the put. Put means selling, and if he's selling a selling put, he is selling a put. Put itself means bearish. So if he's selling a bearish call, that means he's bullish. Bull call spreads and bull put spreads. So we'll see what are these spreads. Bearish will be opposite, long puts, short calls, bear put spreads. And neutral is market is not expected to go anywhere. So there would be butterflies, condors and straddles. So we'll see all of them in the next slides, but take it with a pinch of, information, that this is more of knowledge sharing by the curriculum, not an actual expectation of you to build any strategies in the exam, right? Okay, long call strategy. Whenever you get into strategy, break the words. Long means bullish. Call also means bullish. So you are bullish on this one. It's a straightforward strategy. You buy the call option, you pay the premium. If it works in the money, you exercise this. If it goes out of the money, you let it expire worthless. You can see the example, 10-year G-Sec future with a strike of 97 and a premium of 1.5. So the break even becomes 98.5 if you add it. If the future price goes above 98.5, I will be in profit. What is the maximum loss? The maximum loss is the premium that I've paid because this is the buy call option. Gain is unlimited. Suppose this becomes 105. I'll have 6.5 as the profit. It becomes 110. Then I'll have 11.5 as the profit. So there's no theoretically it is limited because the bond price will go up to certain limit only. The interest rate cannot go non-negative. So that is the case. But yeah, in terms of theoretical pricing, it is unlimited. And maximum loss, because you're buying an option, the maximum loss is always equal to the premium. We studied that. So that was basic. Again, long put is also similar. Long means buying, put means bearish. So you are expecting the market to fall. If you expect the yield to spike, if the yield is supposed to spike, the price will go down. If the price is expected to go down, you will buy a bearish instrument or buy a put. Again, if you buy the put at 96 and you pay a premium of 1.2, the future price should fall below 94.8. Why? Because 1.2 is the premium that you have already paid. And you're expecting the market to go down. So that's why it's on the reverse direction. And you have paid 2,400 rupees per contract for this. Maximum gain is also capped up till the price reaches zero in that sense. But maximum loss will always be the premium. In a short brief, just understand buying a put or a call, the maximum loss is premium and the maximum profit theoretically is limited, but in the book it's written unlimited, so that you can understand from the example. And it also depends on what instrument. Under equity it will be unlimited because there is no ceiling for any equity price, but under bond prices the interest rate cannot go non-negative, so interest rate will always be non-negative. So that case, zero would be the ceiling. Now over here again, spread is an important topic. Let's break the word. Bull call. Bull means buy. Call is again buy. The word spread. Spread means like collar. Your spread between this and this. This is the spread that you have. Now you will enter into a, suppose I am a bullish on some instrument, or I'm bullish on some bond price to increase, okay, but I am not that bullish. I am saying that okay, I'm bullish, but I'm bullish only up till 10%, say let's say 10%. So if I buy only a call and I enter into this contract, I will have to pay the premium. Say example, the premium is 8 rupees for simplicity. But my vision is only up till 10%. I'm not expecting the movement to be more than 10%. So might as well, I will sell a call and earn 6 rupees premium, so that I'm still bullish, but my outflow is only 2 rupees. Because here I will be paying the premium of 8 rupees by buying a call, and here I will sell a higher call at 6 rupees. So my total premium is only 2 rupees. So I'm still bullish at a lower cost. So that's what written over here. Buy a call strike at 96. So 96 is bought, premium is paid for 2.5. So 2.5 is gone from the pocket. Sell the call at 100 because I am bullish, but I am bullish only up till 100. So here I'll get a premium. Say I get 0.8 as the premium. So my total outflow has gone from 2.5 to 1.7 because this is what I've paid and this is what I'm going to get. So my net premium is 1.7. If the profit increases as future prices rises to 100, the maximum profit of 2.3. Now what will happen in this case is I have bought a call at 96 and I have sold a call at 100. If the bond price closes at 100, I will have to sell it. I cannot still keep it. Even if the market goes up, even if the market goes to 101, I will get the profit only up till 100 because I have already sold a call at 100. So in spread, you have to give up the upside because you have already capped your upside. That's why it's a spread. Maximum loss will always be net premium. Why? Because here you have bought a call, but here already you have sold a call. So when you have sold a call and if the market goes against you, it will get arrested at 96. Even if the market goes against you, it will get arrested at 96. And on the top side, it will get arrested at 100. So in this case, you have made a spread for yourself. That 96 to 100 is your spread. Maximum loss, you will have the net premium, and maximum profit will be between 96 and 100. That is 4 rupees. But you have paid 1.7. So 4 minus 1.7, 2.3 will be your maximum profit in this case. So again, understand, whenever you're given a strategy, break the words. Bull call, bull means buy, call means bullish, spread means there will be a buy and a sell in the same series at a lower and a higher price. So the very first one is, now let's see, bear put against, bear means bearish, obviously. Selling, put is again bearish, spread is again. Now suppose I expect the bond to go down. I expect the bond to go down, but I'm not that bearish. I'm bearish, say, by 10%. I'm feeling that the current price right now is 98 and I feel that it will go up till 94. Not bearish much, but still bearish. So what will I do? I will buy the put at 98 and I will pay the premium 2.20. So this is a premium which is already gone out of the pocket. And I will sell a put at 94. Why will I sell a put? Because I am bearish at 98, but I'm bearish only up till 94. I don't feel that it will go below 94. So if I'm buying a put here to negate my contract, I will have to sell a put here. If I'm buying a put here at 98 to negate this contract, I'll have to sell a put here. So that's what written over here. Buy a put at 98, sell a put at 94. When you're selling a put, you will receive the premium. So paid and received net will be 1.5 is the premium paid, because 2.2 you paid, 0.70 you got, so 1.5 is the premium paid. Maximum profit will be 98 minus 94. 98 minus 94 is 4 rupees, but you have already paid 1.5 premium, so minus 1.5. Maximum profit will be 2.5 always. Maximum loss is 1.5 because that is the net premium that you have paid. And break even will be at 96.5 because 94 is your purchase price and 1.5 is your net premium, that is 96.5. Sorry, 98.5, 98 minus 1.5. This is a put, not a call. So we did it incorrect over here. It should be, remember this is a put. So in the put, you're bearish. So you will deduct the premium. So 98 is where you bought the put, but you entered into the put by paying a net premium of 1.5, so 96.5. So just understand, bull call, when you're bullish but not that bullish, you are slightly bullish. Bear put, you are bearish, not that bearish, slightly bearish. Let's see, we'll move on to the next part, which is the straddle strategy over here. What we can do is, see, now in the previous scenario, we saw the slightly bullish and a slightly bearish scenario. Now, suppose you're entering into the bond, futures or options contract when the market is highly volatile. You don't know where the market will go, whether it will go on the upside or the downside. But wherever it will go with high velocity, because suppose there is an event like a Fed meeting or an election in US or any other election, could be in India also, something like that. So that is a straddle strategy where you buy both a call option or a put option. Why are you buying both? Because you don't know where the market will go. You don't know where the market will go. The strategy profits from significant price movement in either direction, making it ideal when expecting high volatility but uncertain about direction. As I mentioned, I am uncertain about the direction, but my expectation is whichever direction it goes, it will be very highly volatile. So it's a high volatility bet. Premium cost is expensive. Why? Because here you are buying the call and the put both. Here you are buying the call and the put both. So here your premiums are expensive. Here you will have two break-even points, one on the upside and one on the downside, because here you are buying a call and buying the put both. So here you will have two break-even points, one on the upside and one on the downside. So straddle, remember, is for high volatility. Simple example over here which is given. So this is the payoff diagram for a straddle. You don't know which direction. It could be bearish or it could be bullish. So this is what we have written over here. A trader expects significant interest rate volatility during an RBI policy announcement, is unsure of the direction. Current price is 97. So current price is 97. So it can either go to 100 or it can either go to 94. Example. So the call option premium is 1.8. So call option is 1.8 and the put option is 1.7. Strike is 97. So I buy call and put both for 97. Total cost is 1.8 plus 1.5 is 3.5 total cost. Buying the put and buying the call. The future price must rise upon for profit. If the future price must rise upon how much price? See, if I'm on the bullish side, I've already paid 3.5 and the strike is 97. So until I cross 100.5, I am in no profit zone. At 100.5, I'm at break even zone. Above 100.5, I'm in profit. So till below 100.5, I'm in loss. At 100.5, I'm break even. Similarly, on the downside, 97 minus 3.5, that is 93.5. So if the market goes down until it crosses 93.5, I am in loss. So that is the scenario. So this is the only case where there will be two break-even points because here you are buying the put and call both. Similarly to straddle is the strangle strategy, but it uses out of the money options with different strike prices. So in the previous one, we used the same strike price of 97 and we expected the price to go either way. So we bought the put and the call on the same strike price. Here the strike price could be different. So let's take an example. Current futures price is at 97. So we buy a call at 99 and we buy a put at 95. For buying the call, I paid 1 rupee. For buying the put, I paid 0.90. So total premium is 1.90. So the difference between long straddle and long strangle is basically when you are expecting high volatility, but that was the case in strangle also. In straddle also, you were expecting high volatility, but the difference is in straddle, you were buying the call option on the at the money options. At the money options will be expensive because it is closer to the strike price. Here you are slightly out of the money, slightly out of the money. You're buying a out of the money options and out of the money options will be cheaper. The only thing that can protect you when you enter into a strangle strategy is basically when you expect large price movement. If there is no large price movement, this becomes a disadvantage for you and you might lose the premium altogether. Why you require large movement? See, in strangle, this is the payoff diagram. So let me create the straddle one. So in straddle, this was the payoff diagram, right? Here. Let me just make it more prominent. So this was the payoff diagram for straddle. Now, between this and this, there will be some price difference because this is created at 97. This is created at what? 99. So the 2 rupee movement that is expected, if it does not happen, a strangle will expire worthless and you will end up paying the net premium. So the difference between straddle and strangle is basically strangle will have out of the money option and different strike price. Straddle will have at the money or in the money options and at same strike price. So that is the major difference. Now let's see bear put against
So we'll take certain questions that I mentioned. So the first question is, what is the margin requirement and leverage? See, this is a future and an option product, right? So any future and option product will be traded on exchange, and exchange requires a guarantee for you to settle the trades. So which is why you need to put money in the margin account when you're trading in the futures. And when you are selling the options, at that time also you need to provide a margin. Leverage means because you have put only the margin, you have not put the entire amount, you are taking 1:2 or 1:3 kind of a leverage, wherein if the trade moves in your direction, you will make a 3x profit. Second one is, how do you manage the downside risk in such a trade? I think so that answer came through the spread that we are doing. So spreads are generally used to manage the downside risk, but the flip side is your profits are also capped. So in when the agenda is to manage the downside risk, you generally do a spread. Straddle and strangle both are expensive because in this case you are buying the options on both the sides, so you are paying the premium. So straddles and strangles both are expensive, but they are deployed only when there is an event which is expected, like there is a budget, there is a GDP numbers which are going to come out, there is a monetary policy committee, there is a war going on where you're expecting already high volatility. The next question is, does strangle should be practically used as the risk of losing premium is higher? Yeah, so that's the same answer, right? The strangle and straddle will only be used when you're expecting high volatility. Now, let's see, in this budget itself, we saw the movement in the index of more than 1,000 points, right? So 1,000 points in Nifty is a very high movement. So in this scenario, you will enter into a call and a put, wherein you will buy both the call and the put. If the movement comes in one direction, the one option will become worthless, either the call or the option or the put option, and the other option will make the profit because the stock will move in the other direction. So you do a straddle and strangle only when the volatility is high. Let's move on.
Now, butterfly spread, don't get intimidated by the name. Butterfly spread, we already know spread means buying and selling simultaneously. So why it's known as butterfly? A butterfly spread is a neutral strategy that profits from low volatility. If you expect no, RBI is not going to say anything and the markets are not going to react, let me take a benefit of this and let me capture the premium for the market. So you can enter into butterfly spread. It involves buying option at two outer strikes and selling two options at the middle strike. So over here in our case, let's see, we buy one call at 100. So this is the call option we bought. Sell two calls at strike 97. So this is the first call we sold. This is the second call we sold. And buy one call at 94. Again, we bought the call over here. Now what we essentially doing? When buying a 100 call and buying a 94 call, I am saying that the market is going to go up. But if the market does not perform well, I am also selling the call at 97. I am also selling the call at 97. So what I'm doing, I am essentially reducing my cost because I am buying a 100 ka call and I am buying 94 call. Both the calls I have bought, which is currently at an extreme of 4 or 5 points from 97, 3 points from 97, both of the points. So what I'm doing, I'm essentially taking and saying that from 97, if it goes down, I will sell it at 94. From 97, if it goes up, I will sell it at 100. Or I will exit the position at 100. I will exit the position at 100. This will reduce my cost. How will it reduce the cost? Let's see again. I will erase all these things and let's understand it again. I'm selling two strikes. I'm selling two calls. Call number 1 at 97. Call number 2 again at 97. Now this call can go on the either side. Suppose it goes to 94. I'm buying it again. That's what I'm doing it here. Suppose this call goes to 100. I am buying it again. So essentially I am creating spread, a spread wherein my maximum profit is already defined. My maximum profit is already defined. Now maximum profit occurs when the future price equals to the middle strike 97 at expiration. Losses are limited to the net premium when futures move significantly beyond outer strikes. Suppose it goes above 100. Do I need to care? No, because the one I sold over here is already bought at 100. The one I sold over here is already bought at 94. So even if it goes above 100, I don't really make a loss. And if it goes below, do I have to worry again? No, I don't have to worry because I have limited my calls upside and downside. I will only make profit if the price does not go anywhere. So the maximum profit will occur at 97. I am expecting the price to not go anywhere. That is the maximum profit that I am expecting. It's known as butterfly because over here, if you see, it's taken a shape of a butterfly. It takes a shape of a butterfly, not actually, but it's known as a butterfly. Again, a simple strategy, but fancy names given over here, iron condor. So the payoff iron condor looks like a plateau. So this is the payoff. Because you make the maximum profit in the middle and face limited risk if the stock moves outside the direction. Is a combination of bull put spread. So bull put we saw buy a put and sell a put. So buy a put at 98 and sell a put at 94. This was bull put. And a bear call spread, creating a range bound strategy where profits when future remain within a specified range. That means iron condor and butterfly both expect low volatility. That is the expectation from you. You have to understand which strategy is high volatility and low volatility. Whenever there is a buy and a sell together, on the same asset, like buying a call and selling a call on the same asset, that means it's a range bound strategy. It's a range bound strategy. That is why you're buying and selling at the same time. So like coming back to iron condor, how do you create this? You sell a put at 95. So you short a put at 95. Sell a put means you are bullish. Buy a put at 93. Buy a put at 93. That means you are bearish. So if you have sold a put at 95 and if the market falls, anyway is going to buy it at 93 because you have already said that if it goes to 93, I have already bought a put. At 95, I have short a put. Similarly, you sell a call at 99 and buy a call at 101. Again, if the call goes on the upside or at 101, it will get restricted. So maximum profit will be the net premium collected if the future remains between 95 and 99. The maximum profit over here will be only if the stock remains between 95 and 99, not the stock, the bond price. That's why over here it is written that the profit are plateau kind of a shape. So as long as the bond price is between 95 and 99, you will make a profit because you have created an iron condor around it. You have created a spread around it. So that is the whole idea of iron condor strategy. Calendar spread, as the name says, calendar means months because options and futures are already traded in months. Involves buying and selling options with the same strike but different expiry dates. Sell a near month call at 97. Say suppose Feb month call at 97. You sell this call and you earn 1.5. You earn 1.5 rupees as the premium and you buy far month call for rupees 2.20. So I will buy a May call for 2.20, strike remaining at 95 only. So earlier I had to pay 2.20 if I wanted to buy the May strategy, but I don't want to spend so much right now. I would want to spend less. So I will sell a near term call and get this premium, invest this premium over here. So the net payment that I'll have to do is 0.7. Near month option decays faster than far month options. If the future remains 97, the short expires worthless while the long retains value. Now over here we know that in options, T1 is greater than T2, which is your theta decay. So if the month is expiring, your option will lose its value quickly. That's why you are selling the near month call at 105 at 1.5. That means there are less chances for the prices to go up because it's almost clear to expiry. So this will anyways come to you because the buyer will not exercise and this will become worthless. So you keep the premium, and here you're paying the premium. Here you have to pay 2.20 and you're getting 1.50. So your net premium is 0.70. So that is the calendar spread. Now, what are the arbitrage opportunities in exchange traded interest rate derivatives? Cash futures, we know buying in cash, selling in futures if the futures is overpriced. Calendar arbitrage, trading price difference between future contracts with different expiry. We again saw Feb and May month. So there could be a change in or an arbitrage opportunity in the price. And the put call parity arbitrage. So this we will see in with the help of formula. So this is the formula for this. This is put plus strike and call plus, I think so, something like that. Yeah. So that is the whole criteria over here. It could be the asset over here, any asset. In this case, it will be the bond. That is a put call parity. So if this equation fails, there is an arbitrage opportunity. So we'll see all of these three in a detailed view now. Now, butterfly spread, don't get in the government bond future, cash future arbitrage. It exploits temporary mispricing between spot and the future market. So spot is current and futures is in the future. So say Feb month, March month, April month, there is some futures going on. My actual future price should be spot price plus carry cost minus carry benefit. We have seen that future price is equal to spot into 1 plus the rate at which it is compounding. So this is your formula. So this is the no arbitrage formula. When futures are overpriced relative to the spot, you buy the bonds in cash market and sell the futures. If futures is overpriced, suppose this is 100 and this is 104 and the cost to carry is 100 plus 2. So this is the total value, but the actual value in the future market is 104. It is overpriced, so you will sell at 104 and buy at 102. So you make a 2 rupees profit. So that is called positive arbitrage. And a negative arbitrage when the futures are underpriced. Suppose the cost was 102 and the futures is at 101. In that case, you will sell the spot and buy the future. Because the future is underpriced. Here the future is overpriced. If it is overpriced, what you do? You sell. If it is underpriced, what you do? You buy. What will you buy? Depending on what's overpriced. If the future is overpriced, you sell the future. If the future is underpriced, you buy the future. So this is your cash and carry arbitrage, similar to what you have seen in futures and forwards contract. Let's see an example. A 10-year GSEC is trading at 98 in the spot market. So again, spot is at 98. The bond pays 7%. So 7% is your R over here. Semi-annual coupon financing cost is 5%. Cost of borrowing, COB. Spot is 98. Financing cost for 9 days is 5% into 90 by 365 because that's for 3 days, 3 months, it's 1.21. Similarly, cost of carry is 7% into 90 by 365 is 1.73. Now 1.73 is your gain and 1.21 is the loan that you have to, loan interest that you have to pay. So how much you have to pay? That will be the difference between them. So 98 minus 0.52 is 97.42, 97.48, sorry. So this should be the future price. If the actual future price trades at 98.5, an arbitrage opportunity exists. Which arbitrage opportunity exists? This should be the future price. If the future is here, future is overpriced, then you sell the futures. That's what you are doing. Sell the futures and earn the difference between spot and future. So this is similar to what we have seen in the cash and carry arbitrage. If the future is overpriced, you sell the futures. If the future is underpriced, you buy the futures. So there are two terms written over here, contango and backwardation. Don't get intimidated. Contango is when the futures is greater than the spot. Backwardation is when the future is less than the spot. So if FAR month futures, now say we are in Feb month and let's take September as the FAR month futures, are trading to the premium to the near month futures. So suppose Feb is trading at 98 and September is 99.15. Then it's a positive carry. Spread should equal to the net financing minus corpus. If the spread is too wide, we sell the FAR month and buy the new month. Suppose this is not 99.5. This becomes 100.75 and you do the calculation of cost of carry and you find that the average price should be around this price. If it is not, what will you do? If the future is overpriced, you sell the futures. If the future is underpriced, you buy the future. So if you're selling the overpriced future, that means you'll have to buy the spot futures. So sell the FAR month futures and buy the near month futures. Opposite is, if the FAR month futures are trading at a discount to new month future, unusual in the interest rate market but possible during extreme conditions. Backwardation may signal expectation of falling interest rates or temporary supply demand imbalances. Now, generally, a yield curve is always upward sloping. That means the future, which should always be greater than spot, because that is the cost of carry. When will the future be less than spot? Only when the interest rates are zero or negative, because compounding at any rate will still create a premium. So if the interest rates are near zero or negative, that means the expectation is for the markets to fall. The expectation is the interest rate to fall. And if the expectation of the interest rate is to fall and the future price, if the future price goes into too much of discount, you will buy the futures and you will sell the near month futures. You will buy the FAR month future and you will sell the near month future. So always remember calendar spread. Calendar means months. Spread means buying and selling the same asset across multiple tenure. So the put call parity is similar to what you have seen in the equity one. In the equity one, we had seen the formula like this, where here is a call and the put and here is the asset. Asset in this case is future contract. This is a strike price. If you take this over here, it becomes, if this goes here, it becomes C minus P. So here it is a price, C minus P equal to future price minus strike price, future price minus strike price. So if the call trades at 2.5 and put is at 1.8 and this is the strike price, calculation wise, you see that the parity is violated because on the left hand side the computation is coming as 0.70, on the right hand side the computation is coming at 1. So to exploit this 0.3 arbitrage, you will buy the call, sell the put, sell the futures and lock in 0.3 as a risk-free profit. Why it is risk-free? Arbitrage by definition means a risk-free profit, because it is taking an advantage of the mispricing in the market. So again, this is the formula. Call and put. This is the asset over here. So if you take the put over here, it becomes this formula, or you can use this formula only. SPXC, X could be the strike price, whatever they are mentioning, and S is the asset. Here is, in this case, is the future price. We now see the intermarket arbitrage. Intermarket, again, let's break the pride. Inter means different. So intermarket arbitrage exploits price difference for similar instrument across different markets. This requires simultaneous execution in multiple markets. Let's say BSE, NSE in India for simplicity perspective. If any bond is trading over here at X price and it is trading over here at X.05 price, there is a mispricing. You can sell it over here and buy it over here because it is premium over here. So that is called as the intermarket arbitrage. Price difference from same future contract on multiple exchanges, BSE, NSE. Mispricing, this could be one scenario. Mispricing between OTC and the exchange traded. Suppose a bond A is trading at X price, and in the OTC market it is at X.01, let's say 100.01, and in the futures market it is at 100.10. So there is a difference. So you can buy over here and sell over here. Discrepancies between government bond futures and corporate bond futures. So what is the major difference between government bond and corporate bond? It is the credit spread, because government might not default, but a corporate can default. Suppose the credit spread is already counted for 25 bips. And now, for some reason, the spread between the government bond futures and corporate bond futures appears to be 35 bips. That means the bond market is mispriced and you can benefit from this mispricing. Cross-border arbitrage between domestic and international interest rate markets. This can happen when you have good knowledge of the currency movement. Suppose you have a dollar bond, you have an INR bond of a similar profile, but the currencies are different. You might want to benefit from this as long as you can hedge the foreign exchange risk. Cash futures, as I mentioned, interest rate in India is managed both by SEBI and RBI. Is intra commodity. Intra means same. Inter means different. Trading spreads between different maturities of the same underlying. Suppose there is a GSEC over here, GSEC yield curve, and a 2-year rate and a 10-year rate. And the 2-year 10-year rate should actually have been like this, but it is like this. That means there is a mispricing. So you can buy and sell within the yield curve. So this is also often known as riding the yield curve. Inter-commodity spread between different underlyings, government bond and corporate bond. We saw that in the last thing, that if the credit spread is 25 bips expected, and if it goes to say 35 bips, for example, that means the yield curve can shift and you can profit from the shift of the yield curve. Butterfly spreads, we have seen earlier. What is a butterfly spreads? It basically tries to lock in your loss and maximum profit so that it expects very less volatility. So whenever there is a less volatility, your losses and profits are capped and you pocket the net premium. Yield curve spread strategies, we saw this. Yield curve spread strategies profit from changes in the shape of the yield curve. So suppose this is a yield curve, this is already created. Suppose it steepens. That means bonds over here will fall because the interest rates have gone high. And the bonds over here, suppose it went like this. The bonds over here will gain because the interest rates have gone down. Look at the red curve. This is the expected change. So the bonds over here will gain because the interest rates have gone down. The bonds over here will fall as the interest rates have gone up. So you can profit. You buy the short-term futures. Why? Because you will get gain over here. And sell the long-term futures. Why? Because here it will fall. Flattening. Let's take another color. Suppose it goes like this, like this, like this. Maybe I'll take some other color. Let's take a green color. and it flattens out. Flattens out means the interest rate is going down. Interest rate is going down means that I will buy the bond here and I will sell the bond here. Why? Because here the interest rates are rising. If the interest rates are going down here, that means the bond price will increase, because if the interest rate goes down, the price increases. For this yield curve to get flat, the interest rate has to go down. And if it goes down, the price will increase. And what we do when the price is expected to increase, you buy the long-term futures. And over here, the price will decrease because the interest rate is going up. The price will go down. You sell the short-term futures. So that is the whole idea, that if the yield curve steepens, you buy short-term, sell long-term. If the yield curve flattens, you buy long-term, sell short-term. So there are some limitations of these exchange traded interest rate derivatives. That is basis risk. That is the spot interest rate derivatives. That is basis risk. That is the spot is. That is basis risk. That is the spot and the futures market might not always be in sync. So that is the risk that is might not always be in sync. So that is the risk that is always there in the market, and the hedge will not be complete. There will be some unhedged exposure. Standardization constraint. Suppose you enter into a bond market and you have $5 million of bond, but you don't have any relevant security in the futures market to hedge that, because in the future market there is standardization. So you might not get the bond of same size, maturity or underlying characteristic. Margin requirements, obviously, as I told you, futures are daily MTM settlement. You have to settle the profit and loss every day with the intermediary. And accounting complexity. Why? Because over here, the concept of hedge accounting comes over here, which is a requirement under IFRS. So we'll not get into this, but just from a subject perspective, let's understand that it brings in the accounting complexity, because you have to prove that the hedge is effective. Managing hedge effectiveness, you can do a regular rebalancing. This is again under IFRS, which is the International Financial Reporting Standards for Accounting, under which you have to do a regular rebalancing, periodic adjusting hedge ratios to account for changes in duration and portfolio composition. Monitor the hedge effectiveness, such as correlation, tracking error and value at risk, to ensure hedge remains effective. And there's a lot of documentation requirement to be compliant to hedge effectiveness and claim an IFRS compliant reporting. So if you're an IFRS compliant reporting and you are claiming to be hedge effective in terms of the processes that you are following to manage your portfolio, you will have to do a regular rebalancing of your portfolio. Then what are the risk management best practices? Position limits, stress testing, contingency planning. So as a trader, you need to have a limit defined on your positions, exposure limit, your risk limit, capital limit, and you should completely monitor that. You should regularly stress test. Suppose you want to stress test what will happen if the market goes up or down by 10%, and you will run this scenario and you will see what is the maximum loss that is expected from the market in case a 10% move happens in the market. Contingency planning, develop action plans for adverse scenarios. Like you should always have some cash in liquid form, because if the market goes down or up volatility in a very volatile manner, the margin call will trigger and you will have to furnish the cash to the broker or the intermediary. So that way you have to always keep a contingent cash reserve. So as I mentioned, in India, the interest rate derivatives are regulated both by RBI and SEBI, because banks are the primary participants in the interest rate market in India. So I'll just pause the slide over here for you to read, but more or less it is what we have already covered. Position limits are imposed by the exchanges. Requirements of large positions require reporting. Margin settlement is on daily basis, which is written over here. Documentation is required to understand the derivative risk. So this is self-explanatory. I will just pause the slide over here for 20 seconds for you to see. But more or less, we have seen all of these items in the other slides for derivatives and the risk of derivatives. Technology and execution consideration. Exchange traded interest rate derivatives require sophisticated technology infrastructure for market analysis, order execution, and risk monitoring. Advanced OMS, which is order management system, are required for real-time risk monitoring system tracking, margin requirements, and P&L across all positions. So, see, unlike equity, right? Equity is linear. Either it will go up or down, and you have to just compute the MTM. In interest rate derivatives, there are a lot of moving parts like interest rate itself, prices, duration, convexity, call or put options, basis risk, futures risk. So those too many moving parts. So it requires a sophisticated system. Comprehensive market data feeds are required for providing pricing and liquidity information. And a lot of analytical tools are required for scenario analysis and backtesting. What is backtesting? Is basically, suppose you created a scenario, say in 10% market rise, my portfolio will go down by 5%. To actually test this scenario is called as backtesting, wherein you will put the data and the model has told you that, okay, in this scenario, 5% is your expected loss. You will run the scenario and see actually whether it is 5% or not, which is the backtesting on the data. Finally, we come to the last slide, which is conclusion. Finally, we come to the last slide, which is conclusion. Finally, we come to the last slide, which is conclusion. Interest rate derivatives often offer versatile tools for hedging, speculation, and arbitrage. We saw that there are three types of participants: hedgers, speculators, and arbitrageurs. You should be clear in your objective whether you're a hedger, speculator, or an arbitrager. Finally, we come to the last slide, which is conclusion. Interest rate derivatives often offer versatile tools for hedging, speculation, and arbitrage. We saw that there are three types of participants: hedgers, speculators. Spread trading strategies, intra commodity. Intra means same. Inter means interest rate derivatives often offer versatile tools for hedging, speculation, and arbitrage. We saw that there are three types of participants: hedgers, speculators, and arbitrageurs. You should be clear in your objective whether you're a hedger, speculator, or an arbitrager. It's a continuous learning curve. Why? Because the interest rate market has many moving parts, right? Interest rate yield, prices, convexity, duration, and anything in the global market can impact it. So you require to continuously learn the market movements. Analysis of the structure, because you need to know what is the payoff diagram of the options, what is the expected profit and loss. You need to implement robust risk management because options and futures are leveraged and they can create magnified profits and losses. And lastly, be regulatory compliant because, as I mentioned, interest rate in India is managed both by SEBI and RBI. RBI because banks are the largest participants in the interest rate market. So again, I'll just repeat in this chapter, don't focus more on the calculation, focus more on the strategy. What kind of strategy is applied when? You don't have to actually calculate or explain the payoff diagram, but more or less understand what is the overall messaging of the chapter. Thank you. Spread trading strategy.
Yeah. So let's go by each question. The first one, I think so. Most of you have given the correct answer. Hedging for multiple bonds in a portfolio can be done by using duration-based hedge ratio. Unlike stock, which does not have a duration, bonds have duration, and you can hedge the risk by hedging the duration risk. Second is, the second one is in bullish vertical spread. What do you choose? You choose the buy. So over here you are bullish. That means you want to benefit from the movement of the stock or the bond on the upside. So the correct option is to buy the put option with lower strike and sell the put option with higher strike. Why? Because you will have a premium which you will receive by selling the put option. Third one is, if you expect the interest rate will go up in the future, you should sell. Why? Because if the interest rate goes up, the price will go down. And when you know the prices are going to go down, that's when you will sell the bond futures. Fourth one is, a calendar spread is where the trader buys a particular month future and sell it for the different month. If you see the word itself, the month means it is related to calendar, right? The calendar spread is where a trader buys a particular month and sells for the another month. The last one is limitation of interest rate derivatives for hedgers is mainly due to A and B both, because for hedgers there is less standardized contracts, because hedgers will have a particular date. They will be receiving some goods on a particular date, so they want to hedge it. And also non-availability of all kind of underlying instruments. Still, the bond market in India is not that developed. It is still developing, but in terms of the global market. But yeah, so these are the two limitations that we have in the current market for hedgers particularly. Thank you. Let's meet you in the next session for the other chapters of this section.